Hey everyone, welcome back to Corporate Decoder. Today, CRH just filed an 8K about a major acquisition, and I'm seeing one key detail that really stood out. Quick note, this is not financial advice, just my take on public filings for educational purposes. CRH is buying Arcosa in a huge deal, and the financing behind it is particularly interesting. Alright, so CRH Public Limited Company, a big name in building materials, is making a significant move. They are acquiring Arcosa Incorporated, and this 8K filing is all about the details of this agreement. The earliest event reported here is the 21st of June 2026, which is when the merger agreement was officially signed. CRH is a publicly traded company with its ordinary shares listed on the New York Stock Exchange alongside a whole slew of its guaranteed notes, which are also traded on the NYSE. These notes range from 5.200% guaranteed notes due 2029 all the way out to 5.600% guaranteed notes due 2056. It really shows CRH has a substantial debt structure to manage. The core of this filing is about a very important agreement CRH has entered into. It is officially called an agreement and plan of merger, or in simpler terms, a merger agreement. In this deal, CRH Americas Inc., a subsidiary of CRH, is merging with Arcosa Inc. Arcosa will become a wholly owned subsidiary of CRH after this is all said and done. So, what is Arcosa worth according to this deal? Each share of Arcosa's common stock will be converted into the right to receive a cool $150 in cash. No interest, just cold hard cash, subject of course to any taxes they need to withhold. This is what is called the merger consideration. This isn't just about the stock. Any Arcosa restricted stock units or restricted shares that were granted before this agreement will also be cashed out. They will get the merger consideration, which is that $150 per S-share multiplied by the number of shares tied to their award. If the award was based on performance, they get the cash based on either 100% of the target performance or their actual performance, if that was higher, as decided by Arcosa's board. Now, making this deal happen is not automatic. There are several conditions that need to be met. First, Arcosa's shareholders need to approve the merger agreement. It is a majority vote of the outstanding shares. Then no government entity can issue an order that stops the merger. They also need to get approval under the Hart-Scott Rodino Antitrust Improvements Act, basically making sure this deal doesn't create a monopoly. And of course, other typical conditions like making sure the company's promises in the agreement are true, and that neither side has had a major negative change in their business. CRH is requiring Arcosa to hold a special meeting for its shareholders to vote on this deal. Arcosa's board is also expected to recommend that their shareholders vote yes. Here is an interesting part. CRH has put in a no-shop clause. This means Arcosa generally can't go looking for other offers or talk to other potential buyers after signing this deal. However, there is a fiduciary out. This allows Arcosa's board to consider a superior proposal from another party under specific circumstances. If they do decide to go with a better offer, they can break this deal with CRH, but will have to pay a termination fee. This is pretty standard in these big acquisition agreements. Speaking of termination fees, this agreement has them. If the merger isn't completed by the 21st of June 2027, which is called the outside date, either party might be able to terminate. There are provisions for extending this date if regulatory approvals are still pending. If CRH has to pay a termination fee, it is a hefty $371,967,952. This would happen under specific circumstances, mainly if the deal falls apart due to antitrust or other regulatory issues. On the flip side, if Arcosa is the one terminating the deal to accept a superior offer. Or if CRH terminates because Arcosa's board changes its recommendation to shareholders, Arcosa has to pay CRH a termination fee of $260,377,567. This section is crucial for regulatory approvals. CRH and Arcosa are required to use their best efforts to get all the necessary government approvals. This can include CRH agreeing to sell off certain parts of its business or Arcosa's business, if regulators deem it necessary to prevent competitive issues. They call these regulatory remedial actions. There are limits though. CRH won't be forced to sell or divest assets that are too material, meaning they won't give up a huge chunk of their business just to get this deal done. Arcosa can't agree to any of these without CRH say so. And CRH leads the strategy for getting these approvals. Importantly, the deal is not dependent on CRH securing financing, which is a big point. This part is about public relations. On the 22nd of June 2026, the day after the merger agreement was signed, CRH and Arcosa issued a joint press release announcing the deal. They also scheduled a conference call and webcast for investors to discuss the merger. An investor presentation was also prepared. The information in these public releases, while important, is generally not considered part of the official filing for legal liability purposes, unless specifically stated otherwise. Here we get into the financing for this massive acquisition. It is called a bridge facility agreement. CRH as the guarantor and its subsidiary CRH Americas Finance, Inc. as the borrower have entered into this agreement. Lenders, including big names like JP Morgan Say and Morgan Stanley Bank International Limited, have committed to providing a $5.75 billion term loan facility. This is the bridge loan. This $5.75 billion loan is meant to help pay for Arcosa, refinance some of Arcosa's existing debt, and cover related expenses. However, the plan is to replace this bridge's loan with more permanent financing before the merger officially closes. This could be through new term loans or issuing more senior notes. The actual funding of this bridge loan is subject to some typical closing conditions as well. Now, moving on to another piece of news related to this acquisition. CRH is not planning to start a new phase of its share buyback program once the current one finishes around the 28th of July, 2026. They will look at their buyback program again later, depending on market conditions and what their priorities are for allocating money. This is where you'd find the full unredacted merger agreement. It is attached as Exhibit 2.1. They've omitted some schedules and exhibits, likely to keep the filing cleaner, but CRH says they will provide those to the SEC if requested. And as with most of these filings, there is a section on forward-looking statements. This is a standard legal disclaimer. It basically says that CRH is making predictions about the future, like how the merger will go or how its finances will look. They warn that these statements are based on current expectations, and that actual results could be very different due to various risks and uncertainties. They mention things like the possibility of the merger agreement being terminated, Arcosa shareholders not approving the deal, or regulatory hurdles. They also point to the risk factors listed in their previous annual report as important things to consider. To wrap it up, CRH's acquisition of Arcosa for $150. Per share in cash is a massive deal, approximately an $8.5 billion transaction according to external news. The immediate financing is a $5.75 billion bridge loan, which is significant but expected to be replaced. The no shop clause with a fiduciary out is standard but highlights the delicate negotiation balance. The termination fees are substantial, signaling the seriousness of the commitment. While CRH is not immediately continuing its share buyback program, the focus is clearly on integrating Arcosa. The real story here is how CRH is financing this huge purchase and the potential complexities of getting regulatory approval, which might involve asset divestitures. The risk I am watching is the effectiveness of their plans to replace the bridge financing with long-term debt under potentially fluctuating interest rate environments. My biggest concern is the integration of Arcosa into CRH's vast operations and whether the projected synergies will materialize. What I am actually looking for is more detail on the long-term financing strategy. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.